Dave Knight here from 123daytrade.com, and today's topic, when we get to it, probably around the 2-minute mark after I talk a few minutes, was going to be on volume versus your risk in trading. Now, kind of a recap of where I am right now inside Top Step Trader. I'm waiting to be funded. I have spoke to John Hoagland on this week. I have filled out all my paperwork that I need to get completed. Right now, I'm waiting for them to let me know how I should pay my data fees, and I'm looking to hopefully start the most likely um, around October 5th, 2015. That's kind of like my target date, although most likely I will be starting my trading October 6th, 2015, which will be a Tuesday. So it's like a week and a few days away right now is kind of my target start date that I want to start on. So once again, that'd be October 6th, 2015. So I'm waiting for them basically. Oh, and by the way, I have my interview with Eddie Horn on September 28th at 12:30 Central Standard Time or 1:30 Eastern or New York time. Just that's PM, by the way. So if you want to tune into that, then you can come into Top Step Trader. You can listen to it, or eventually it will be uploaded to YouTube. I'm well, they get uploaded to YouTube, and then I'll be able to take the interview and put it into a blog post that I'll feature as well. All right, so let's get into volume versus risk in trading. Now, the reason that I thought about this topic was I was in my practice account today. I run across this kind of thing occasionally in my trading, and I wonder, what should I be running with, volume versus risk? And what I've come to conclusion is that what you need to do is look at the volume. So let me pull my spreadsheet out, because maybe this will make a little bit better sense if I highlight what we're talking about. And let me get my screen draw tool out so you can see exactly what area I'm looking at. So I've added this into the spreadsheet right here, and this is average volume, high, extreme, and then blow off volume. And I haven't made up my mind what I would risk on blow off volume, but right now I put 1R. So average volume, well, I put 400 to 699, and I determined that that should be a one half R, or half an R. So if I look at half R today, it's 11.2, rounds up to 12, right? That's kind of what I went with today, and that's what I normally go with anyway, right? If I look at high volume, that's 700 through 699, and that should be 2/3 R. So if I look at 2/3 R today, it says that I should be at 15 ticks right there, right? And I'm going to add another column in here, and I'm going to call it 1 full R. It's also right here, because this was my original, and it's actually figured into the calc sheet right here, right there. But although today it rounds up to 22.5, which would round up to 23, which physically would mean that this should be at 44.02 and not 03 on an entry point of 44.25. And I'll show you that entry point here as we get ready to take a look at the trade. So now, what do I mean by volume over here? So you see I've listed volume figures, and what am I talking about? What I'm talking about is volume that you see in the charts. And if you see what I listed here, get that screen draw tool again, right here is 1725 right there. So that's the highest volume figure that you see on here, and this actually 1227 comes later at 9 a.m. and that's a whole ball of wax all by itself, so we won't worry with that right now. So what we have is 1725, and so that's the highest volume figure, which ends up being this volume bar right there. So it's this volume bar right here. before the open outcry open right here at 8, and this is the opening range. So here's your 8 o'clock open, and this is 8:05 right here. So here's your 5-minute range. And if you look at this in particular, what you can see is that the range is roughly here to here. And here's your 1 point, right? Here's your 2, here's your 3, and then it proceeds to move up this way, right? And this is your entry point, which if you look, if you can see my chart, you see that I came in right here at 44.25. And then if you look here, it looks like I got stopped out on this run right about here. And then I thought, well, let's try again, which is not really in part of my plan. My plan should be the one trade at the, so you got your one, and I should be sitting in the second trade looking for the bar 700, HVS 700 bar. But I got stopped out at 1/2 R here, and I run into this problem more than I care to admit, where I get into the trade and then it goes straight to my stop loss, and then it comes right back up, and then it moves, and then it proceeds to go the direction that I originally thought it was going to go to start with. Now, the epiphany that came to me is that why, if I have volume figures, why don't I use that volume to help me determine where I should place my stop loss? So, you know I like to use that 1/2 R all the way up to 1 R, right? So, and I've been toying around with the idea of, I need a drink. I've been toying around with the idea that you need that. Your R should be based upon volume, and you see that in the spreadsheet based upon right here the average daily range, right? And if you don't know that, this is a volatility figure, as you see right here. Here's volatility 2.25, your velocity 25.3, which ends up being this, or it's 1p move. So how fast is the market moving? It's going to move 25 ticks in one way quickly, is what I believe. And then this volume figure actually needs to be worked on here a little bit, because as the contract rolls out, and the other one, let's not worry about that. So that's the volume. This is an average volume over 9 days. This is low. It should be around closer to 217,000 than 156. So I need to fix the spreadsheets what I'm getting at on this particular volume figure. It has a lot to do with when one contract rolls off and the next contract comes on. So in other words, when October rolls off in November, in this case, there's not as much volume in the first few days of well, basically in the September area that we're in, compared to where we are right now. So hopefully that kind of makes sense. But this is, anyway, so what I'm getting at in this training is that basically this right here, this 1725 bar, is extreme volume, is how I'd look at it. And then you have your blow off volume that's above 2500. So I guess you could say extreme volume is anywhere between 1,000 to 2,499, round up to 2,500 if you want to. But that is an extreme volume bar. Now this qualifies as an extreme volume bar inside what will end up being the CL port method, or the crude oil power open range trade method. And what you have to do is, if this here, I should be taking a 1R target. In this case, I should be looking at a 22.5 stop loss, or in this case, rounded up to 23 ticks. Now you see how I drew a line in the charts here at, this is 22 ticks by the way, at 44.03, but it could be at 44.02. Let me move it to where. So if you look at 44.02, it was never run in the movement, and you can see that this looks like the second stop loss was hit right here, and the first stop loss was hit right in this area. So yeah, right here. So it was hit originally right in here, and the second time it was hit here, and maybe that was the third entry. But anyway, I ended up getting a bunch of entries today. In fact, I had 5 entries on my practice account where if I would have just stuck with using helping volume help lead the way, in other words, because I like to use that, let the volume lead the way. So if I would have used this volume over here to help determine my R is what I'm getting at, then it would have been an easier decision. So this extreme volume should have had me looking at a 1R target. In other words, 23 tick stop loss is what I'm getting at. So if you would take and then you can look at that on a spreadsheet, right? So 44.25 was your entry point. Let me draw my lines up here for you, the horizontal lines, so you see the range I'm talking about. So here's your range. And here's your 1 point. There's your 2. Here's your 3. It runs up here prior to 8:05. It sells back down, and then it comes back up here. This is where 8:05 happens. So I was looking to get long above the 2 point, right? So right here at 8:07, I get long, and it comes down. And if I would have held at 44.03 or 44.02, notice that that doesn't get hit, right? So if I move this over so you can see it a little bit better. Here's 44.02 right here, and in fact this is 44.03. Now, is this curve fitting? Perhaps, but I find myself sitting in a trade, and right here is where the 12 tick stop loss gets hit. And then I think to myself, wow, this market, this happened within 1 minute too. Wow, I still feel very strong about the CL port method trade. With looking at the volume figures, that big red bar over here has me thinking that this is a good buy stop that came into the market, and this is a good area. So in other words, right here, as this corresponds with this, the market, it's really going to have to push really hard to get down here below this area, which is 43.80, at least on the trading session that I was looking at. So that is my thought process, that I believe that it's going to have to really push hard to get down that low. Now notice it comes down here, it comes down, it gets a little bit lower, right? But you don't see any corresponding volume. So this is pretty much telling you that the buy orders are in and the market looks stronger than weaker. At least that's how I view that particular trade. So what I'm getting at overall is that you should let volume versus your risk, so R, and how should you view that in your trading. In this case, if I would have kept R, in this case, based upon what the volume spike bar would tell me, in this case, it would be a 1 full R target, I would have been able to stay in this trade. And in fact, it goes up. Now, see, this is nowhere in here does it run underneath. It gets close several different times, comes down to 44.04 several different times within the morning session. And finally, it makes its run up. I think right about here is where it runs up to 3p. And then you see this mark here. Let me see here. I believe this is where 3p, yeah, 44.17 today. So if I look at this right here, based upon yeah, there he goes. 45.01 was 3p, but it doesn't run up to 4. It stops after 3p. It goes up to 45.01, but it does not reach up to 45.26. So what I'm getting at is when the market runs 3p, I should have a stop of no less than 1.5p. So here's 3. Here's your movement up. Now, yeah, you could have taken 3p, but let me show you this and why I believe that why I was still feeling that this market still had some up to go right here. Right here is 45.17. Look at where the pivot point is right here. The pivot point was at 45.39. So if I look here, my target was 45.26. Now, yeah, you know, I mean, if it was wanted to make a move up, then I humbly believe that we could have seen 46 on the way up today, 7p, you know, or up to, say, 5p at 45.51. But I really believe the market, if it was strong at all, would have at least made it up back to pivot. So that would make it 45.39. So, you know, to worry about, oh wow, 45.01 and 3p is not necessarily the whole point of the what I as I look at this trade, as I would trade it back down. In other words, I would be looking to get out between 1.5p to 2p. So in other words, after it would run up to the 3p target, which would have been right here, 45.01, my exit would have been somewhere between 45.76 to 45.63. So there would be where I would find value and where I would have exited. So if I would have held at 1R, I wouldn't have generated 5 different trades a day, first thing. I wouldn't have been down 48 ticks. If it would have run me out, I would have only been down 23 ticks on one trade, and that would have been the end of that trade, and I would have been looking for another trade past the 830 mark that would be greater than 700. That would keep me in the trade longer, but it also allows me to use the volume spike bar to help determine where I should place, how far I should make the R. So for instance, if it was been a normal bar of, say, anywhere between 400 to 699, yeah, it would have made sense to go at 1/2 R. 700 to 999, 2/3 of an R, and so in other words 15 ticks. And then above that 999 up to 24.99, so 1,000 to 24.99 would make it 1 full R, just like you saw on this particular bar way back here at the 730 mark. This was the high spike bar that lets me know that there's more buyers and sellers in the market, and this will help me adjust R in the trade itself. So this high volume spike bar, as I look at this skyscraper that's in front of me almost at 1700, is letting me know that I should be running at 1R. In other words, today, on today's spreadsheet, would have run it at 23 ticks or 22 ticks. So in other words, $220 to $230 stop loss on the trade. I would have stayed in the trade, and this happens quite a lot in my trading. It's like, how far should I move, you know, based upon, you know, and it happens. I get knocked out in the second trade, and you know, it's frustrating. It's a frustrating thing to happen in your trading when you get in and you think, wow, you know, if I would have just had a little bit wider stop, I'd have stayed in the trade. So knowing that, as I look at it as a trader, I know an R is where I have my maximum amount of loss that I'm willing to take in one trade. So in this case, my maximum amount of loss on one trade is the R target, and I firmly believe that. And you, in my video training that I've talked about, you know that I put myself, I have the ability to trade all the way to that R. And in this case, if I would have allowed myself to take the R instead of the 1/2 R, I wouldn't have accumulated 5 trades a day and hit minus 48. I might have only had one trade at minus 22, minus 23. So I think it's kind of a better way of looking at the market and looking at my trading, and I hope that this helps you in your trading as well. God bless, take care, and we'll see you on the next video. Bye for now.